Hey guys, welcome everybody to day 22 of the trading marathon here on this channel. My name is Daniel, and in today's video I'm gonna give you an overview over the several indicators that we have for free to use on TradingView. And as I already pointed out in yesterday's video, I'm not using any of them in my active analysis or in my active trading, but I want to give you a complete package of the knowledge of chart analysis so that you can decide for yourself what's working for you, how you want to build your strategy, and so on and so forth. So that's why we are going over some other indicators in today's video, but I'm not obviously gonna talk as long as I talked about the RSI, about every single indicator, because otherwise it would take days, okay? I think the first one that I'm going to show you is the so-called MACD indicator, and the MACD indicator is basically consisting out of two different moving averages. We are going to search for the MACD indicator, and it's a so-called moving average convergence divergence indicator, and as I already pointed out, it's consisting out of two different moving averages, and also some kind of a motion range here that we have. As you can see, on the right hand side we have some kind of a number scale that we can make bigger and smaller, but I want to just introduce you to the concept. Here above the MACD indicator we see the RSI, which we can also, just for your information, we can put many indicators at the same time on our chart. They will all be displayed here, and we can also like make the size in the way we want it to have. We can also zoom in and out in the several indicators themselves, and we can also adjust the settings we have for all the different indicators. So for example, the RSI, as I explained to you yesterday, you can manage the settings of how many candles will be taken into consideration when comparing the relative strength. In the MACD indicator, as I pointed out, it's consisting out of two moving averages. So obviously you are having you are having actually three settings. The first setting is the first moving average you're using for the indicator. The second number is the second moving average you're using for the indicator, and the third number is the amount of days, or somehow in between. Let's check it out for ourselves. I don't want to give you incorrect information. You see, 12 in this case, the fast length is the moving average, which has the small amount of days or candles in comparison to the other one, because as you can see, the slow length is so to say the longer one. We can also make the slow length to 21, for example. Yeah, let's do that. And the fast length to, here there are 13. Okay, so let's put in 13 right here, and the signal length, let's go here with 21 as well. Okay, adjusted it. So 13, 21, 21, that would be what I would be looking at. And well, I'm gonna explain you to the concept, okay? Because also, well, it's gonna take some time. I'm not going through many indicators with you. I'm showing the MACD to you and maybe one, two other ones, but I don't want to confuse them with too many indicators anyways, because it makes really no sense. Just pick one of them, or maybe two. But basically, since we have two moving averages, one of them is always the faster one, right? Which is calculated with the smaller amount of candles, and one is the slower one. So what that means, just follow the logic. The one which is faster at one point will adapt faster to what is happening on the chart, and will always be faster pointing towards the direction in which the price is actually moving right now. So what that means is, if we are in a downtrend all of the time, probably the small moving average will be lower than the fast one. And once we are turning to the upside, the smaller moving average will be the faster one to adapt, so it will cross the slow moving average towards the upside. So that's called, so to say, golden cross, which is a buying signal. And obviously vice versa, if the fast moving average crosses the slow one from the upside towards the downside, then it's considered a death cross. I'm gonna point that out to you here. For example, well, let's go to a bigger time frame. Let's set a daily chart, and let's look, for example, here we had the cross towards the downside. Can you see? The blue moving average is the fast one, right? It was above, Here, exactly in this moment, the fast one, the blue one, went below the orange one, which was the so-called death cross. I make it red here so that you can see it's a sell signal, okay? And let's check out what was happening right at this moment on the chart. Boom, this exact top, you can see it was at the exact same moment, okay? So this indicator gives us some good signals. Let's check out, for example, the other direction. Let's check out here, we had a bullish cross. Let's mark it in green. And let's check out where the chart was right at this moment. Boom. Here. Yes, here's the exact moment. So if you, for example, took this bullish cross for serious and just sold at the bearish death cross, you would have just longed up this C wave. Well, if you only have the MACD indicator, you would be already shaking here or something, yeah, like you would not know the exact targets, but in combination with Elliott wave, if you already see this as an impulse and a correction, and you expect another impulse towards the upside, and then you get this bullish cross on the MACD, you take it serious, you measure your price targets, you take the 100% extension, which is the minimum target to reach here, boom, you go out. And then you even see the death cross, bam, you enter in the short. You get the concept here. So the one signal, actually it has two types of signals to make the indicator. One of them is this crossing of the orange and the blue line that we have on the indicator. The other signal, well, it's actually exactly the same. It's just displayed in a different way. It's the red and the green bars that you see down there in the indicator task line. For example, in the moment we had the death cross, right there was when the MACD shifted from these green candles to the red ones. Right in the moment here when we had the buying signals, this was the moment when the MACD shifted from the red candles to the green ones. And so on and so forth. We can point out the same exact thing right here. For example, that's a good one. This was a selling signal, you see, it turned from green to red in exactly this moment. Also the blue line and the orange line crossed each other at exactly this moment, and let's check out where this was here on the chart. Right there, bam, selling signal MACD here. And then let's check out where the buying signal happened. It was exactly here, you can see. Boom, blue line crossed the orange one from the downside towards the upside. Here, wait, let's make it green. Tuck. Here the bars turned from red to green, and in the exact same moment here, the chart was at this height. So also, for example, if you take this one serious and then later on, yeah, well, it would have resulted basically in a break even, but then from there on you get the next buying signal. So you understand what I mean, right? It's not 100% reliable, obviously. Take it all with a pinch of salt. You cannot make a trading strategy. I mean, technically you can. You can just follow the RSI. You need to be very disciplined, and you also need to understand that while the candles are forming, the indicator is moving as well. So sometimes what happens is we form a big red candle. You think the MACD or something is, like already turning, and then boom, by a liquidity sweep, it gets bought off and the indicator changes, like it can change if it's crossing or not, like in a moment, like not afterwards, but in a moment of happening, it can actually change that, yes. So be very careful with it. Don't base your whole strategy on the RSI node, on the MACD node, not on any indicator, but you can obviously use them as additional confirmation. For example, that's what I'm really, not advising to do, but that's what I'm doing, and I'm 100% confident it's the best way to do it, since I'm doing it since 6 years, all the different types, and that's what I found out, and make the overall analysis by Elliott waves. Then look for entries via smart money concepts, and then use the indicators as indications to maybe notice in early stages when you're right, when you're wrong. When you're right, then you see it anyways, but maybe, check the indicators for some signals that you would not expect, so that you see, maybe I need to rethink one or the other thing. But generally they work, generally they, they make sense to also take a look at, but I would not base the whole thing on them. Let's maybe check out one more indicator. Well, okay, I'm gonna show you two simple concepts. I'm gonna show you the stochastic RSI, and I'm gonna show you the simple moving averages. I think that's gonna give you, that are 4 indicators then that you have in your repertoire that you can really also, you know, like work with and not are fully random. For example, if we take out the stochastic RSI, well, we delete the momentum, it's kind of weak to work with it. The stochastic RSI basically follows the same principle as the normal RSI. Wait, let's put some normal numbers in it. Okay. Yes, that's a good way to look at this indicator. Yes. Well, as you can see, I'm really only using Fibonacci numbers. I already pointed them out in yesterday's video to you. 5 are Fibonacci numbers, 21 are Fibonacci number. It's just the exact same concept as the RSI, but you must know that it's calculated in a little bit, in a slightly different way. That's why it's reacting a little bit faster. But also I can only point out, well, first of all, we have these divergences, but I would absolutely not work with divergences on the stochastic since it's way too quick and way too choppy. Okay, so don't look out for convergences or divergences on the stochastic RSI, please. No, that makes no sense. But the buying and selling areas, they are to be taken into consideration. For example, if we check out, here was a buying signal, it was exactly that one. Here was a buying signal, it was exactly this low. Here was a buying signal, it was exactly that low. Well, here not even, yeah, well, here was a buying signal, here was a buying signal. I point them out on the chart here for you, here. I mean, at any low basically, but I can also point out to you, those alls were scams, you know? That's why I don't even like the stochastic RSI to use at all, because it's reacting too quickly. It's, you know, like if you every time when a stochastic RSI says something, act, bam, you will be stopped first time, second time, third time, fourth time, fifth time, sixth time, bam, it makes no sense, trust me. That's why I really prefer the normal RSI over the stochastic, but as you can see, it also, you know, is there with a reason. For example, if we now change the color to red, here was the selling signal, here was the selling signal, boom. So as you can see, basically every bottom was called out by the stochastic RSI by a buying signal, and every top was called out by the stochastic RSI by a selling signal, but it has way too many of them. There are also some not accurate ones. So you really don't want to listen on a stochastic RSI only. Okay, you can, well, I personally never look at it, you know, but if you really want, you can. But I honestly give you my advice from the heart. The more things you look at, the more confused you will get, and the more reasons you will have to not do something. So, you know, I'm just really giving you this information just for a sense of completeness. Okay, Amy. Last but not least, well, first of all, we delete the stochastic RSI since I don't like him. But last but not least, I will explain you the concept of the moving averages. I will put them on the chart. Simple moving average, Doug. Yeah, let's put some on the chart. Yeah, okay, 2 we can only get. I mean, as the name already calls it out, it's the moving average that you can calculate, you know, based on the previous candles. If you, for example, if you want to calculate the moving average of the last 9 candles, you just add them together, the value, and divide by 9, so you get the average, right? And always where this average is, that's where they draw the line. Okay, so you understand, if we get a fast movement to the upside, this average will also go up, and if we go to the downside with the price, this average will also go down, and depending on how short or how little candles or how many candles you use for this calculation, this line will adapt faster or slower. So that's why you can exactly apply the same concept as on a MACD indicator, but only that you can, but also additionally that you can see it on the chart. I mean, it's kind of coming to the same concept, same as with stochastic RSI and RSI, but I mean, you can watch them on the chart if you want. Let's, for example, put in here 21. Boom. So, and here we put in 5. Boom. And one of them man, Yes, one of them will be done white. So you see right now the white line and the blue line on the chart. Let's check out where they crossed to the downside. It was a selling signal, boom, right here, sold here. So all the time short, right? Let's check out where they crossed here, right there, bam. Let's check out where they crossed here on the top. Well, you got another one here. You got another one here. I mean, you get the concept, right? And then once it crossed below, it stayed below. I mean, here it went slightly above, but then like once it went below, boom, you got a whole thing. And once it went above here, so you would close the short, you would be in profit, right? So you also understand the concept of moving averages. They work over and over again, and once the price is above, for example, these moving averages, they act kind of like as a support. But be very careful and don't use them as a point to put your stop loss, because sometimes they dip slightly below and then they go above. For example, here, boom, slightly below tuck there, if we look at the price in comparison to the moving average. But generally, if we look at the buying and selling signals, here would be a buying signal, as you can see, since we get the bullish cross, here would be the selling signal. But also I can only mention, you know, there are periods, for example, sideways movement. In every single sideways movement, this indicator will fuck you. For example, stop loss, 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 stop loss. And starting from here, it makes sense again, you know. On the upside, bam, 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 bam. Here, cross below, so one take profit. You would have made this movement profit in a long, you know, if we make it green. But this would be, by looking on the indicator, your stop loss sessions, you know. One stop loss thrown at your neck one day after the other, because it just makes no sense to move moving average in a sideways movement, because, you know, as I told you, it's the average calculated of the candles. So if they go all sideways, the moving averages will go sideways, and once there is one small upwards movement, they will cross, boom, you will get stopped. Once there's a small downwards movement, they will cross bearish, boom, you will get stopped. And this can happen 10, 20 times. So please, my friends, if you use the moving averages, please don't take them too serious and don't act on every single signal. You know, the RSI, you can, if you put the settings in that I introduced you to, you can, you know, like take him somehow serious. But with all the other indicators, also the ones that I showed you, man, please, you know, respect yourself and your Elliott wave analysis that I will teach you to do. Please always 100 times more than any moving average or any stochastic RSI, okay? Ever, okay? Please respect yourself and your Elliott wave analysis. But be patient now. We're done with the indicators, okay? So starting from tomorrow, I'm gonna really introduce you to Elliott wave, how to do it. And last but not least, then I will show you how to use smart money concepts so that you can really fish out the best entries in the best way, or in the highest educated way possible. So we have, by the way, guys, yesterday was I need to show you my half. Today is right now, for example, also the evening. So yesterday on the 21st, I recorded first the video and I ran my half marathon afterwards. So that's why I didn't show it to you yesterday. So here's the 21st half marathon. But today it's already, you know, like 11 p.m. So I already did my half marathon for today. So here's the 22nd half marathon on June 22nd. Yes. So that's that, guys. Now we are through with the indicators. Tomorrow starts the Elliott wave. I hope you're excited. That's really like the most important chapter, but we will take also many days to get into it. So if today is over, we will have 20 more days left, since today is the 22nd when I'm recording it. Okay, so we have 20 more videos left. Well, guys, can you believe it? In 20 more videos, so 20 more days, you will have actually all the knowledge that you need to be really a predator in the market, a successful one. So I hope you enjoy the journey, guys, and we see each other in tomorrow's video. Stay hard. Ciao, ciao.